Warriors of price action and guardians of fundamentals, welcome to Retail Recon. On today's episode, we're starting from absolute ground zero on two massive pillars of modern trading, options and futures. These are both types of derivatives, which are financial contracts whose value comes from something else, like individual stocks, indexes, commodities, currencies, or even interest rates. They allow you to control very large positions in the market with relatively small amounts of your own money. But there's a warning that you need to understand right from the beginning. One of these instruments comes with a clearly defined maximum risk, while the other exposes you to potentially unlimited losses in both directions. Choosing the wrong one for your situation or misunderstanding how they function can lead to account blowups faster than you can imagine. The objective of this mission is straightforward. Have a complete understanding of what derivatives are, how options give you the right to complete a trade at a specific price, and how futures create binding legal commitments that you cannot walk away from. We'll go through important mechanics behind both instruments, the different types of risks involved, and when and how you might consider using them. Before we dive into options and futures, it is essential that we establish a rock-solid understanding of what derivatives are. A derivative, at its most basic level, is simply a financial contract between two parties whose value is directly derived from the price movement of something else, which we call the underlying asset. That underlying asset could be almost anything in the financial world. An individual stock like Microsoft, a broad market index like the S&P 500, a physical commodity like crude oil, gold, or wheat, a currency pair like euro dollar or dollar yen, or even something more abstract like interest rates or volatility itself. The single most important thing you need to understand is that when you buy or sell a derivative, you do not actually own the underlying asset. You own a contract, a legally binding agreement that gives you exposure to what happens to that underlying asset's price. To use a real-world analogy, it's like buying insurance on your neighbor's house. If that house burns down, the insurance company pays you based on the damage to the house even though you never owned it. You have exposure to what happens to that house without possessing it. Derivatives work exactly the same way. They give you exposure to price movements up or down. What makes derivatives so powerful and so dangerous is leverage. Leverage means you can control a much larger position in the market than the amount of money you actually put up. For example, with just $1,000 of your own money, a well-structured derivative might give you exposure to $10,000 or even $20,000 worth of stock market movement. Small price changes in the underlying create much larger changes in the value of your derivative position. That amplification works brilliantly when you are right and catastrophically when you are wrong. There are four main categories of derivatives that you will hear about: options, futures, forwards, and swaps. Forwards and swaps are mostly used by big institutions and banks in the over-the-counter deals that retail traders never touch. Today we are focusing exclusively on the two derivatives that are actually accessible to the retail traders through standard brokerage accounts, options, and futures. These are the ones you can trade on platforms like Interactive Brokers on Robinhood. Now let's break down options from the ground up. You've heard this several times by now, but it's always worth repeating. An option is a contract between a buyer and a seller that gives the buyer the right, but not the obligation, to either buy or sell the underlying asset from the seller at a specific price called the strike, either on or before a specific date in the future called the expiration date. The seller of the option takes on the exact opposite position. They have the obligation to fulfill that right if the buyer decides to exercise the option. The seller of the option gets assigned and he has to either sell the shares at a specific price in case of a call or buy the shares at a specific price in case of the put. If you want a deep dive on the option basics, check out episode Options 101. Unlike futures, the buyer of an option pays a non-refundable fee upfront to the seller called the premium. This premium is quoted as a dollar amount per share, but since each standard stock option contract controls exactly 100 shares of the underlying stock, you always multiply by 100 to get your actual dollar cost. That premium payment represents the maximum possible loss for the option buyer, no matter what happens to the underlying price. If the option expires worthless because the price never moves in your favor, you lose 100% of the premium you paid and nothing more. For the option seller, that premium becomes pure profit if the option expires worthless, but they carry the obligation to deliver if the buyer exercises. There are two important styles of options, American style and European style. American style options, which cover most individual stock options, can be exercised, turned into actual stock, by the owner at any time before expiration if they are in the money. European style options, which are common for index options like S&P 500, can only be exercised at expiration. Most retail traders stick to American style stock options because they are more flexible. One thing I would also mention in this section are option Greeks, which are mathematical measures of how the options price will change under different conditions. The most important ones for beginners are delta, which tells you how much the option price will change for every dollar move in the underlying stock, and theta, which measures how much value the option loses each day as time passes. If these sound complicated right now, don't worry. We'll do a deep dive on the Greeks in the future episode. For now, just understand that the premium you pay reflects all these factors combined. Now that you have a basic understanding of what options are, let's move to the futures, which operate on a completely different principle and carry dramatically different risks. A future contract is a legally binding, standardized agreement between a buyer and a seller to buy or sell a specific quantity of the underlying asset at a predetermined price on a specific date in the future. Unlike options, there is no right involved. Both parties have a strict obligation to fulfill the contract when the delivery date arrives, unless they close their position earlier. Futures contracts are traded on centralized exchanges like the Chicago Mercantile Exchange, CME, or Intercontinental Exchange, ICE, and they are highly standardized in terms of contract size, expiration dates, and settlement procedures. This standardization is what makes futures extremely liquid and accessible, but it also means you cannot walk away from your commitment. Unlike options, where the buyer pays an upfront premium to the seller, futures do not involve any upfront payment between buyer and seller. Instead, both parties must post something called margin, which is essentially a good faith deposit or collateral held by the exchange to ensure they can fulfill the contract. This margin is typically only 5 to 15% of the total contract value, which creates massive leverage, but it also exposes you to potentially unlimited losses in both directions. Futures can theoretically lose more than your entire account balance if the market moves sharply against you before you can react. Every futures contract has very specific, standardized specifications set by the exchange. These include the contract size, how much underlying each contract represents, the tick size, smallest price movement, the tick value, dollar amount per tick, and the expiration schedule, usually quarterly for major indexes. Trading happens electronically nearly 24 hours a day, 5 days a week. Unlike options, futures settle daily mark to market. That is, end of day profit loss hits your cash balance immediately. Winners credited, losers debited. No waiting for expiration. Let's now go through the use cases and the risks associated with it. Options sign for retail because of built-in asymmetry. Buyers risk only premium for a potential unlimited upside. Perfect for the first and most accessible use case for options, especially for beginners who want to generate income without massive directional bets, is selling covered calls and cash-secured puts as part of the wheel strategy. This creates consistent theta income with stock you like owning. Since this strategy is very common and highly efficient way of generating income, I'll explain it in detail in the future episode. I personally use it on a regular basis, especially on highly liquid index ETFs. Next, directional speculation with defined risk. Use case is instead of buying 10 shares of an expensive stock, you buy one call. You can even have stock-like exposure by buying leaps months into the future. Hedging ranks third. By buying protective puts, you effectively contract insurance without selling winners. And lastly, flexibility. Spreads for defined risk on both sides. Let's now go through the risks. The first and most universal risk with option is time decay, also called theta. Every single day that passes, an option loses some of its time value, regardless of whether the underlying stock price moves or not. This decay accelerates dramatically in the final 2 weeks before expiration. As a buyer, this works directly against you. Your option becomes cheaper every day unless the stock moves sharply in your favor. As a seller, theta is your best friend because time works for you. Beginners often buy options thinking they have plenty of time, only to watch 50 to 70% of their premium evaporate in the first week if the stock does not cooperate. The second major risk is implied volatility crush. Options prices contain two components, intrinsic value, if any, and time volatility value. Implied volatility, IV, measures how much the market expects the stock to move. Before events like earnings reports, IV spikes, making options expensive. If the actual move is smaller than expected, option price collapses even if the stock moves in your direction. That is known as IV crush. As a general rule, you want to sell options during high IV and buy during low IV. For option sellers, assignment risk is also one of the big dangers. If you sell a naked call and the stock skyrockets, your loss is theoretically unlimited because you have to buy at the market to deliver at the strike. Covered calls mitigate this as you own shares, but early assignment can happen anytime in the money, especially before ex-dividend dates, forcing you to sell shares sooner than planned. Moving on to the futures. They power pure directional bets with insane leverage, 24/5 access, and no theta. It's pure price exposure without any time decay. But futures risk start with unlimited loss potential in both directions. Unlike option buyers who cap losses at the premium paid, futures losers keep losing until you close or get liquidated. A 1% index drop can equal 20% margin loss at 20 times leverage. Gaps are the killer. Margin calls strike when equity is lower than maintenance margin. You have to deposit cash or broker sells you at the worst price. With daily mark to market, you get immediate cash hits, no wait for a bounce. And don't forget interest accruals on debit balances. Psychological risks. The biggest one I see is overconfidence from early wins leading to oversized bets. In both cases, I would strongly advise you to position side trades based on your account size. Trade only with the amount you are prepared to lose and have tight exit rules in place. And with that, we wrap up this episode of Recon Reports. If you found value in this episode, be sure to lock in your support by liking, subscribing, and following our movement. Thanks for standing watch with me today, and until next time, trade smart, risk sharp, and stay on target.